All right, Matt, let's move on. Let's talk about this piece from CBRE.
For sure.
Older versus newer. Okay, so older multifamily properties achieve above average rent growth. Okay.
Yeah.
Interesting.
I know I was like a little bit confused, and I'll be honest. It was like a little bit surprising that CBRE has measured this fairly protracted period of reduced rent growth, which lasts for the first 10 or so years of a building's life relative to the following decades. I know that when an apartment, now this is my kind of conception, is, when an apartment's newly built, the developer or owner tends to offer some attractive concessions and rent discounts, maybe even just lower rent to make sure that the new empty apartment's filled up with renters as quickly as possible. So maybe like the first 3 years or so, the owner's slowly phasing out those concessions and discounts, raising rents to market level, things normalize. I could see lower rent growth in the first 3 to 5 years, but 10 whole years of lower than normal rent growth just doesn't seem like, I can't wrap my head around it.
Yeah.
And so I have a theory. So CBRE explains they said this trend is largely attributable to pre-2010 properties having lower average rents and therefore more room for growth in a continued high demand housing market. In addition, older properties' rent growth has been less volatile, meaning they have been less affected by external shocks like recession. I'm a little bit at a loss. On one hand, the report concludes with a message of like older buildings in general have higher rent growth, and that kind of broadens or generalizes that point. I think that perhaps maybe instead of the blanket idea about all older properties all the time, there's like a historic factor that like the properties that are older now have not been buffeted by this 1-2 punch of the Great Recession and the pandemic, or are they are those recessions affecting at any, their sample size? And then Griffin kind of set me straight as maybe this is the third option, is probably more, and it's something maybe you alluded to when I talked about this yesterday, is maybe around year 10, you get someone that's their interest is in rents and really the cash flow of the building, not necessarily like how much money you make selling it. And because of that, like the operating and the income that you're getting regularly is more of a focus for people that are owning more older buildings, that will drive rents up.
So let me ask you a question. I think this might get us where we're going.
Okay.
If an older property had a lower return than a brand new property, why would you?
Yeah, good point. Yeah. That's flat out. The thing that,
and we're not talking really about returns. We're talking about rent growth.
Yeah,
and there's a reason for that. But just inherently, this isn't surprising.
Yeah,
surprising because people is like, no, it's good, but it's not surprising when you think of, risk in return and risk equaling return.
Yeah,
and CBR mentioned it's like the older properties. It's not. Rent growth is one component.
You got more expenses. Now, it does say that there's less growth volatility, but again, we're only looking at one metric here, and that is rent growth, which is definitely a big component, but it's not the only component. Yeah.
So, I mean, again, they show volatility on the, and that's those like little like lines. I mean, just being, slightly less, the older, just the less volatile they are. But I mean, and I hate to just use like a bucket of anecdotes when like talking about all this, but like it's the best tool, I guess.
I can't understand it other ways. It's just an example.
So it's the mom and pop owner is the best example in case. So they own this property.
Griffin had one. I'll have to tell you.
Okay, good.